Hello traders, Gary Wagner here. It is approximately 11 a.m. in Honolulu, making it 5 o'clock in New York. It is Monday, the first day of October 2012, and this is the daily report for gold and silver. Higher pricing in the precious metals across the board. As you can see, current print is roughly 1774.88, call it 1775. Puts it up about $4 on the day. But if you're ready for this, the intraday high trading in New York this morning was 1793. The market really took off. We'll talk about that throughout the show. Low 1764.10. Now traders, as gold made a new high, so did silver, actually trading well above $35 per ounce, $35.50 being the intraday high. As you can see, current print on the board, approximately $34.70, puts it up about 14 to 17 cents higher on the day, about 0.5%. As I said, high $35.50, low $34.14. You know, when the Fed chairman speaks, the world absolutely listens. In a Q&A to an economic club Ben Bernanke had today, a couple of statements were forthcoming about quantitative easing and his expectation right now that it could possibly be into 2015 as we continue this bond purchase. He also tried to make it a very common sense approach in terms of explaining what that meant. And the interesting thing is we can see the net result. Of course, the market is trading nominally higher, currently trading at about 1775, 1776. But you can clearly see this high, this intraday high that we had, which was 93, and you can also, without a shadow of a doubt, see that it is well above the former intraday high that we had, and I believe that was roughly around 1788. Now, all I have done is converted our longer term chart. I want to convert it back when we talk about the retracement and whether or not we have actually seen the end of this small correction. But when you take a look at this 60-minute chart, you can see quite clearly how quickly the market came up and how quickly the market came back down. In fact, you have 2-hour periods in which the market really surges higher, and it surges really above these former tops. You can see the kind of reality that it had. In other words, as this market started trading, once it broke above these particular tops, it was really far, far and away. The market really took off running. The next hour was really characterized by really consolidation. You can see that small red candle right in there. And then, of course, what followed was the market coming back into alignment, trading really sideways for a little while before trading a little bit lower. And as we can see right now, the market is currently trading up about $4, but well off of those plus $19 highs that we saw this morning. Now, as you can see, I've gone ahead and converted our chart back into a 360-minute chart. You know, the one thing that we really want to ascertain as best we can, of course, we re-entered the market on the long side, but we did so with really 1/3 to 1/4 of the capital that we pulled out in terms of the position that we really made a lot of money on when we bought back in August, covered at 1750, right in that area. And the one thing that we can see, the one thing that's pretty evident to me, and we've been talking about this, and that is the market's been characterized by ascents and then followed by a consolidating period. That, of course, moves us back to another ascent and then another consolidation. Now, we've had this happening now for quite some time. As you can see here, here's our last ascent right up to this 1775 area. Sideways action, however, a little bit different here because what we had here was a definitive correction. You can see that the market actually did come down some. Now, when we look at it under that pretext, the one thing that I find interesting is I have a basic Fibonacci retracement. The retracement itself is really, I'm trying to cover the bulk of this last move, wave one, intermediate wave one within our major fifth wave. And what you can see is that the 23% level is really the first level that we would look at. Of course, 38 is right here. That's just below 1700. Right in here. But the one thing that is clear, you can see that as these markets go up a little bit, they do come down and they tend to find a resting spot, so to speak, at these various areas. There also can be no doubt that as this market came up, this is the high that it made, it has come down and it has retraced actually 23% of this large move up. Now, is that significant? Well, of course, I believe that it is. And the reason that I believe that that's fairly significant is whenever a market genuinely trades higher, even on a runaway bull market, it's going to have periods of consolidation unless it's truly parabolic. And that's not what we're looking at here. So that when we take a look at the big picture, meaning we take a look at this marketplace, it has moved really from about, what, 1540, I have it at 1560 actually, up to this point, which is about 1785 in that area. You actually do have a realistic retracement. It's very, very shallow because a wave 2 can typically be, this would be 50 and this is 61%. You can easily get a pretty deep wave 2, and that wave 2 could take you all the way, as I said here, to about 1650. Now, as of right now, the market has been strong. The fundamentals moving this market, as I've talked about over the last couple of weeks, ever since the announcement by the Fed that they would have an open-ended buying program, this rally that we're witnessing is going to be, I believe, a long, sustained rally, and it will be characterized by periods of ascent and periods of consolidation, but it will also be characterized by waves of corrections. And in a very, very strongly trending market, you can get these narrow corrections. But I by no means think we're out of the woods yet, but it's something that we certainly need to take a look at, be considerate of. And as I said, that's why I positioned ourselves back on the long side. And I'll tell you, when we saw this market moving back to actually a 7-month high, some new highs in the market as it overtook 88, went to 93 on an intraday basis, I was glad that we were repositioned onto the long side. Now, the fact is the market's dipped back down, but it does have momentum, and that momentum definitely favors the. And trader, silver is really no different. We talked about, with some great detail over the weekend, different upside targets that I'm looking to have. But we also talked about the fact that before any of these targets can be feasible as places that we really want to see this market move to and believe it has an opportunity to get to, more importantly, the market needs to take out $35. I will tell you, this morning, as the market was trading and as gold was trading to those new highs, we saw silver really take off. We also saw it begin to trade effectively and solidly above $35 per ounce. Looking at a Henkin chart, it is a daily Henkin chart, and you can see how this market really went up. You can also see that on a daily chart, it does appear as though we're back to green, and we're back to green after seeing the small correction. Now, once again, when we look at this correction in terms of the validity, again, I have put this from really the beginning of this rally up to the top of this rally, and as you can see, it is just shy of a 23% retracement. That would take us to just below $33 an ounce, $32.96 to be exact. And you can see that this low, I believe, was $33.24 if memory serves me correct. And one of the reasons I'll remember that is our stop was at 20, so 4 ticks away. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow on Tuesday for another daily update and review. Bye-bye.